Today's video is going to be a very serious one. This is going to be one you're going to want to pay very close attention to. Every word I say in this video here today. This is not just another video. I have a massive warning I need to give to all of my subscribers, all stock market investors out there on kind of what's going on here, how to plan for this and everything, right? Not sure if you guys saw UPS stock here today. What can Brown do for you? It looks like not much. The stock fell 14 plus percentage points here today. Absolutely brutal day. Look at a 3-year chart of UPS stock. This stock has nearly been cut in half in the past 3 years. Absolutely brutal. Caterpillar, the machinery giant, we can call them. Look at them here today, down about 5 percentage points. I was fortunate to not really notice a lot of the damage that was out there. Public count up around $55,000 here today. A lot of positions, very good for me. You know, Meta's up about $18,000. Tesla's up about $12,000. Cheesecake Factory even up $6,500 today. Palantir up about $5,000. It was a good day overall. Okay, I have a massive warning I need to give to all my subscribers here today. They're setting you up for a massive downfall. And I mean, it's a big one. Okay. I'm going to explain how this is all going to work. I'm going to explain how to avoid this, which is going to be the very, very important part of this video here today. And as I say, with great power comes great responsibility. And obviously I've been blessed to have, a lot of success here on YouTube and have a, really large fan base. And I'm super thankful for that. And I look at it as my responsibility to, when I'm seeing certain things, to go ahead and talk about those, warn people and say, here's exactly what I'm seeing. Here's how to avoid this. Okay. And yeah, I appreciate y'all for being here. I appreciate everybody that smashes that thumbs up button. I appreciate everybody that is subscribed here to the channel. Each and every one of you means a lot, and I hope you're going to get a tremendous amount of value out of today's video because I think this is so needed. Okay, alrighty, very important we start right here. What am I showing you? Well, what I'm showing you right now is stock market charts for the Nasdaq, for the S&P 500, and the Dow Jones Industrial Average since the market bottom in October of 2022. Now, that was around.
Let's pull that up real quick while he's talking here. Let's I'll just pull up the SPY while he's talking. So he said October 2022.
28 months ago. And if we look, it has been an absolutely extraordinary upward move. Now, we have had some drama. We've had some volatility during that last 28 months. Absolutely, right? That's the stock market. But the moral of the story is the Qs are up 100% in the past 28 months. The S&P 500 is up around 70% in the last 28 months. The Dow Jones Industrial Average is up around 51% over that time. That is a stellar, I mean, an absolutely stellar, less than 2.5 years. That's insane, like phenomenal. It's been a banger time. If you've been in the market, you should have made a tremendous amount of money. Like you should be up tens of thousands of dollars, hundreds of thousands, or millions of dollars. I can tell you for me personally, I have made millions, many millions of dollars since this time frame. And I'm very, very thankful for that. Now, not only that, if you look at many of the most popular stocks at, let's call it the Mag 7, look at their performance. It's even more tremendous, right? Nvidia stock's up about 900% since then. Meta stock's up 428%. Google stock's up around 100%. Amazon stock's up close to 100%. Tesla stock's up, 86 plus percent. Microsoft's up 71%. And even Apple, the lagger that is Apple, has appreciated 61% since that October 2022 bottom. That's incredible. Meanwhile, you have stocks like Palantir. Some folks have now 10x their money or more on Palantir stock. I'm fortunate to be up 981% on the stock. It's been an absolute game changer. And yeah, Palantir is not talked about like the Mag 7 stocks are, but let's be quite honest. It's an extremely popular retail stock. If I had to rank them, I would say Tesla's the most popular retail stock, right? And then if I had to say after that, it feels like Palantir, right? Palantir is very, very talked about stock on social media, whether talking X, YouTube, other platforms, very talked about, very invested in from the retail investor community that like to do stock picking, right? And it's just been a game-changing stock. There's no doubt about that. Now, here's where it starts to come into some problems because all that making money, a lot of money, tens of thousands, 100,000, millions of dollars, it's a lot of fun, right? But here's where we start to run into problems. The first problem happens with experienced investors. These are folks that have 5 years or more of investing experience. That might be some folks watching this video. I know some of you guys have been investing for 5, 10, 15, 20, 25, 30 years, right, that are watching this video right now. What usually happens, the pitfall that happens to experienced investors is something starts to flirt with them, and it's called margin. And it's ability to take out extra money to invest. Because sometimes what happens is if you've been investing for a while and you've been making all this money, the little thought comes to your mind about what if I had even more money to invest? Imagine if for every dollar.
So far, this is the best video I've ever seen from Jeremy because I feel like he's really stressing the point of how we absolutely need to be not forgetting about risk, right? When we're looking at the S&P 500 up 70 something percent, Q's up 100%, those Mag 7 stocks up multi-hundreds of percent. I think where he's going here is we can't forget about risk. which is crazy to hear about from a guy who constantly talks about, buying AMD, buying all these stocks that are going to zero. It feels like, I'm not saying AMD is going to zero, but it's sure pointing down like it's going to zero. And where is risk in anything else that he ever talks about? What I talk about constantly is being a risk first trader. Let me introduce myself real quick. My name is Christopher Yule. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where we save time, make money, and start winning with less risk together as a team. Now, we'll continue back on today's video, and be sure to stick around to see how we rank this out of 10, and subscribe if you haven't already.
I was investing over the past couple of years, I had another dollar to invest, right? And you start to say, man, I've made $500,000 over the past 28 months. If only I had double the amount of money, I would be sitting on $1 million of profit, right? And this is something I've experienced it throughout my 16 years of investing. It's something that comes to you, and many times it's after you've been through an epic upward move and you've made a ton of money, and you start saying, gosh, if only I had more money to invest, right?
Forget there's I feel like it's Trading in the Zone, one of my top 5 trading books. I believe he's saying how, when you feel like a winner and you've had a couple winning trades, you decide that nothing can touch you, right? You've got the Midas touch, and then you start taking on bigger trades that you wouldn't have had otherwise. And if those happen to work out, if you happen to get lucky on those, right, you're like, I'm a genius. And so that's when you look for something like margin, which is basically going to double the size of what you can trade with. And that's such a fallacy, right? Because tomorrow's trade is absolutely 100% completely independent of yesterday's trade, right? That trade that you're going to put on tomorrow has 100% of no correlation to the trade you made before, right? Because it's on a different stock, it's on a different day, it's got different buyers and sellers, right? And anytime you put a risk on in the market, the outcome can be completely different, right? Have you ever put on, that's a great example, have you ever put on 2 trades in the same stock and ended up with the same outcome, right? Have you ever bought it at exactly $100 both times and had it go up to exactly $105 both times in the exact same number of days? No, of course not, because every trade, every time you get into the market is unique. And because of that, right, every single time you have the opportunity to lose. And by being a risk first trader, knowing where you're going to get in, but also more importantly, where you're going to get out, I think that's really important here. Tom Basso, one of the market wizards that I worked with, he said, you can buy any stock on any day and it really doesn't matter. The only thing that matters is knowing where you're going to get out. Are you going to get out when it gives back $1? Are you going to get out when it gives back $10? Are you going to get out when it breaks a moving average, right? Knowing where that point is so critical, right? And imagine if the stock continued up, right? Like the SPY is a great example. Imagine if the stock continues up, are you going to give it, how much room are you going to give it to the downside? And then if it does go up, how much room are you going to get it to find out if it's no longer going upward, right? That's where you need to figure this out. That's where you need to stop. You need to take a minute and you need to decide, where am I going to get out? Because so many people, they set this lofty price target, right? They come up with some calculation that's, completely in their own spreadsheet that nobody in the world has access to, nobody in the world is going to trade on, and yet they decide, oh, my price target is 17% higher. I'm going to hold until it reaches that point. And then it goes sideways or it goes down or it only goes up 2 or 3%, right? And you're sitting on the stock for 6 months, 8 months, waiting for that move to happen. But you could have had that exit plan to say, you know what, ready for me to go, I got to bounce. And it may not ever hit that target you put on it, but you need to know where you're going to get out.
And if we look, it's actually pretty evident in the data. What I'm showing you right now is FINRA. And FINRA is showing you how much folks have as far as their debit balances from margin accounts. And we've seen it go from where we were at in December of 2023 to where we're at December 2024.
All right. I'm already digging this video. Jeremy, nice work. Best one you've put out so far.
And we'll see, where this month's numbers at. My guess is it's going to be even higher. But we went from $700 billion of margin debt outstanding to around $900 billion. So we're talking about a 200.
I'm going to let him play in the background while I get a couple things ready.
of $1 billion increase. Now, as the stock market goes up, and this is very important, everybody understands this point I'm about to make. As the stock market goes up, generally, it should go up in terms of how much money is out there on margin. Like it should, right? But that's a pretty big increase of about $200 billion there, which definitely tells me there's a lot of probably more experienced folks that are looking at it and they're saying, man, I've made so much money, but I could have made even more money if I was just margining out, right? Now, if we look here, what happened at the end of 2021? We hit all-time high margin debt levels, right? All-time high, $935 billion of margin debt. Now, keep in mind the stock market is actually a lot higher today, and there's actually the market capitalization of the market in general is actually much higher than where it was back here. This just shows you exactly how extreme things were. The fact that the market.
Do you remember what happened in 2022? He's probably going there. But what I was loading up here was looking at the SPY, right? It looks very similar to this. Very similar to this. And I mean, like some people are claiming that this like 3% pullback on the SPY was extreme greed, according to the CNBC Fear and Greed Index. If we had extreme greed on this tiny of a pullback, let me go back to the daily chart here. If we had extreme greed on this tiny of a or extreme fear, excuse me. If we had extreme fear on this tiny of a pullback, we're freaking screwed. I mean, once we get a real pullback, a real 10% correction, it could be so dangerous. It could be such contagion. It could be blood in the streets everywhere, right? It's exactly this cartoon, right? When someone just hears a rumor of sell and the just panic just sets in everywhere, right? That's the trend that we could be seeing, right? I don't know. But to his point right here, if we peaked in margin in 2021, at the end of 2021, do you remember what happened? I do. I was buying puts like crazy into 2022 because that was the first time we even saw anything go down in the market, right? It's the first time we saw the market pull back in ages, right? This is 2022. It peaked around like literally the last couple of days of December of 2021, and then just like downward trends after downward trends all of 2022. And a lot of people realized what risk was, but then that bottomed and went up since then. And those same people are like, oh, buy the dip, buy the dip, buy the dip, because it always goes up.
Way bigger today, and we actually have less margin debt than back then. But that doesn't mean we couldn't be setting ourselves up for some trouble over the next 6-12 months if margin debt keeps exploding, right? Now look at how low we got by the time the market was kind of bottoming in that fourth quarter of 2022. We got all the way down to $606 billion of margin debt outstanding, a very low number, the lowest number we had been in many years at that point in time. Now the scariest part of this whole margin debt situation is this: the interest rates people have to pay if they're taking out margin is astronomically high right now. Back when we had $935 billion,
that is super high. I didn't realize I got that high.
Of margin debt outstanding, right? Think about where interest rates were at that time. We were talking about interest rates around zero, right? Fed funds rate around zero. It's a long way from zero now at this point in time, right? So I'm looking at Fidelity. I just was like, let me just pull up Fidelity's margin rates, right? If you have, let's say, a $50,000 portfolio and you want to take out margin, you're paying a margin interest rate of 11%. So you need to get 11% return just to pay off the interest on that margin loan. Even if you have $1 million plus portfolio, you're still paying 8.25%. That's extremely high, right? Now I have this circle here because I feel like this is the majority of my subscribers, like the majority of people watching this video right now. You have between $25,000 portfolio and a $250,000 portfolio. My private stock group, a little higher end, so a lot of you guys are probably more in this range, right? But for the general subscriber amount, you guys are in this range. So that means if you are in that range, you're paying like 12 or 11% margin. It's not attractive, especially when you've already been in a multi-year bull cycle, because then you're setting yourself up for a lot of risk. After you've already been through a multi-year bull cycle, at some point in time, the market's going to obviously go the other way, and you're going to be stuck in a situation where you're paying this crazy amount of margin interest. And then next thing you know, you're going to be stuck with margin calls. And it happens quick. It happens very quick. And remember, a lot of the people the same type of people that many times take out margin are same type of people that have trouble controlling that margin. And they let things go overboard there, right? The next group that we have some major troubles, and this is actually the most at risk group, and it's for a different reason. It's for the individuals that might be watching this video right now that you have light experience in the market. You've been investing in the market for 1 to 4 years. You're the most at risk of a major problem here. And here's why. You are in a period where we've had a very nice bull cycle, right? And when you have been in a nice bull cycle and you probably made really good money, it can lead you to a thought process of investing is so easy. right? And I'm sure you guys know the saying, hard times make strong men make good times make weak
This is going to be a #1 top video that I've ever watched of Jeremy's.
weak men make hard times. You might have heard that before, right? You might have heard it on the channel before, because I don't think it's the first time I mentioned that little phrase there. And that's the same exact thing in the stock market. Hard times make really strong investors. For instance, when I got started in the stock market, it was end of 08 going into 2009, right? And I'm getting
like exactly the same time I did. Hard times, like the reason that hard times make strong men is that those strong men are the only ones who figure out how to make things work in a hard time, right? If you've ever struggled as a man, because I know 96% of my audience is men, so I can talk to you. If you ever struggled financially to take care of your family, you had to become a strong man. You had to figure things out, right? A weak man would just sit there, crumble, cry. But a strong man says, okay, I'm going to do what I'm going to do what needs to be done. I will put this burden on my back and I will carry this. A lot of people getting into the market have not had to figure things out. They've just said, oh, buy the dip. It only goes up 100% every 2 years. That's a pretty awesome. I'll just throw all the money I possibly can at it. What risk? There's no risk in the market. He's got a lot of good points in this video.
getting thrown into the stock market where everybody's just getting obliterated. It's hard times. And so what did I focus on? I focused on the fundamentals. I found Warren Buffett. I'm like, okay, here's what he does. Here's how he invests. Oh, he's looking at the
I don't know why anybody focuses on fundamentals, honestly. I have no idea why people focus on fundamentals, because only price pays, okay? Your fundamentals could look incredible, like they did with SoFi after earnings, and then it got monkey hammered, right? It got monkey hammered down 17%. Your fundamentals could be incredible, making the case for AMD, but AMD continues to fall day after day after day. The advanced money destroyer, right? Or your fundamentals could look terrible. I don't know anything about Alibaba's fundamentals. And then price is just on a rocket ship. Fundamentals mean nothing, because at the end of the day, I have one objective, and that's to have more money in my account than I did yesterday. Fundamentals are not going to do that. Only price pays. And this is what you want to see in a stock, right? This is what you want to see. You want to see a stock that, has been beaten up, and then all of a sudden, there's strength here. Oh my gosh, yeah. You don't want to be buying it as it's falling, right? You don't want to be buying it as it's falling down through $90 when it was up at, tell me order blocks don't work. Look at that. Tell me order blocks don't work. Look at this crazy, amazing trend, because only price pays as it's going up, 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 and up. What? This trend is absolutely bonkers. Hang on, I gotta look at this. Just from right here, 39% in 13 days. We could go back even further to where it really developed here, 40% in 43 days. So it really accelerated right there. That's crazy. But it ran right up into that order block and got rejected. Now, looking at this, you had the 10, 20, 50 cross back down. And let's say instead of buying it at 110, you're like, oh, wait. And then it gets down to 100. And you're like, oh, man, 100. I should load up the boat, right? And then it goes down to 90. 95. You're like, oh, man, this is not looking so great. And then it goes down to 90. You're like, oh, okay, maybe I've messed up. And then it goes down to 85, right? And then it hits down to 80. But let's say, for example, you really wanted to buy it at 87, right? It's going down, it's going down, it's going down. But still, all the trend templates pointing down. It finds its bottom, and then it starts coming back up. The trend template shows the 10 over the 20, price over the 50, turns north, turns bullish, and then you can still buy it at 87. You can still buy it at 87. You thought 87 was a great deal when it was back at 115. You're like, I can't believe it. I finally get to buy it at 87 as it continues to go down and down and down. And then, you know what? On the other side of this trend, you can still buy it at 87. But you've saved from November to January, nearly 3 entire months right there of heartache, of frustration. And you got it in at the same price. And now you're getting in it as the price is accelerating to the upside, as the price is gaining momentum, as you're making money, instead of getting in as the price is going down. And there's no guarantee that it's ever going to hit that bottom. It could have gone to 70 before it started to come back up. This is what you want to do right here. This is why when I watch these videos, which this one in particular by Jeremy is actually quite good. But a lot of time when I see these videos coming from YouTubers and they're talking about how, you got to buy it as it's going down. You really don't. Probably should avoid it. And wait until it comes into something like this.
Income statement, the balance sheet, the cash flow. Here's how he thinks about a strong moat around a business, right? And my whole investing thought process was really brought up.
Okay, and just to circle back to here, right? Fundamentals can do whatever in the meantime. Fundamentals can be great, fundamentals can be terrible, but only price pays. And at some point, the price can reverse and start going back up. And that is the opportunity to get in. And then when you have the great fundamentals, if you want that behind you, right? Those fundamentals you can throw in your backpack and say, this is a great reason to buy this stock. And now the price is showing that it's a great time to get into the stock too. Don't just rely on fundamentals, because the fundamentals and price can disconnect and be disconnected for months or years.
In a great time, because at that time, what were you thinking? We need safe business models that are going to survive recessions, right? And so right off the bat, I was kind of like brainwashed in a very positive manner. Whereas if you come into the stock market and it's just easy to get gains, everybody's just talking about upside and upside and upside, it can lead you to become a lazy investor. It can lead you to become, put yourself in a situation where you think this is an easy game. And once you start thinking this is easy, so easy, right? You start to say, I don't need to look at an income statement. I don't need to look at a balance sheet. I don't need to look at a cash flow. I don't need to perform SWOT analysis.
Why would you need to do any of that? Why in the wide world of sports would you need to look at any of that? Explain to me why. Does the price move based on that income statement? Does the price go up because of the balance sheet? Does the price go up because of cash flows or SWOT analysis? No, the price goes up because people are wanting to buy the stock, right? The price goes up because more and more buyers are coming in and saying, hey, I want to buy this stock. Hey, I want to buy this stock, right? Oh, look, it's a virtuous cycle, right? When people see that the stock is going up, they're like, let's go, right? That's investor psychology. But none of these numbers matter. They're just numbers.
Analysis, strengths, weaknesses, opportunities, and threats of a business. I don't need to understand how valuations are done. I just throw some money in a stock and it goes up, right? That is so detrimental to your long-term investing abilities. It will produce you far worse results. What you will find is when the market goes down, you're going to get absolutely obliterated. And when the stock market does go up,
well, no, because if you're smart, you're not going to get obliterated at all, because A, you're looking at the charts, you're seeing where these order blocks are and saying, you know what? I would love to hold it as it's running up into this order block right here. But once it gets up to there, that's my cue to exit. SoFi is a great example. I was telling people for ages, once it gets up to this order block, now's the time to get out. And then it got hammered back down. There was one I looked at yesterday. It was this one right here. Once it gets up into this order block, it's time to exit, right? It had an 18 or something % move day after day on this one, right? Ran up, created this order block. These are selling points. This is where somebody wants to get out. These are large institutional orders waiting to get filled. Price dropped back down, came back up into it. It looks like it might get rejected right out of it again, right? These are really important. And in fact, on the bottom side, check this out for support, right? Created this order block. People want to buy it. Open orders are there ready to buy it when it comes to this zone here. November 15th of 2024, came up, down, bounced out of it, bounced back into it for one candle, create a second one here. And when you stack them, they get even more difficult to break through. And then it went, how many times did it come back into this original order block? So 1, 2, 3 rocket ships. Right? That's pretty cool. And then beyond that, let's go look at Coke, KO, inside of Outlier. I have not looked at this, so I don't even know if this is going to fit my example or not. Let's go look at Coke on the chart while that loads. Okay, cool. Check this out. Coke has been absolutely obliterated. To Jeremy's point, if you are just following price, bro, if you're just following price, this is easy mode, right? If you're just following price, Coke right here is easy mode for days. You've got your 10 over 20, price over the 50, moves all the way up. I look to close. I'll even show you. I'll show you on my chart or on my slide deck here. I look to close if it hits the 10 EMA, right? That's a pullback to me that I want to get out of. Look at this. It went from July all the way up, never once closed under the 10 EMA until September 5th. That's a yellow flag on the field, a red card, whatever, right? Use your sports analogies. I don't watch sports. I don't know. The very first time it closed under the 10 moving average, the 10 period moving average. This is such easy mode. Oh my gosh. I'm going to add this to my list so I can come back to this frequently. This one is such easy mode because it told you, hey, the trend's over. And then it went sideways and then it went down. And it created this order block when it was up there too. So it went up into, how many times did it go up into this order block, right? And they wanted to sell this. Every time it came up into this, they wanted to sell it. It was 1, 2, down, 3, down, 4, down, 5, and then goodbye. This is a great example as to why fundamentals mean nothing. Fundamentals are useless. Follow what's on the chart. The market tells you which direction it's going, okay? And if you follow what we do every single day, it'll tell you. Now let's go to the Coke results here in Outlier. We did just get a buy signal on Coke, okay? Got a buy signal, looks like today, yeah. You can see the fear hit Coke for a while and is now coming out, which means it's getting more and more greedy, okay? And if stocks are getting more and more greedy, that's what I want to see. That means more people are coming in. The consumer staples, that whole sector, in fact, the fear got pretty strong, and now the fear is coming out, getting more and more greedy. That's what you want to see, right? And so we do have that buy signal today. We've got the 10/20 price over the 50. And again, looking at this trend, right? If you were to say, oh, I want to buy Coke at 73, or if I want to buy Coke at 69, right? Well, it's on sale. I need to buy it here. And then it continues to dip down and it gets down to 67, 66, 65, 64. And you're like, oh my gosh, I have to own it at 64, right? Let's say you have to own it at 64. Well, it came through there, right? It's down. Hang on. I'm going to move this around. If you had to own it at 64, it's down basically 13%. And you're like, oh, God, I got to own it here. And it continues to go down and down and down and down. So you've wasted from here to here. You've wasted basically 3 months. You've made no money at all. And then finally it finds its bottom. The trend template turns and we got a buy signal. And now you can still buy it at 64, but you're buying it at 64 with strength, with the wind at its back, rather than buying 64 like you're standing on the train track saying, stop where you are, turn around. No, that's not how this game is played. And I will vehemently disagree with Jeremy on this point here. This is trading, this is investing on easy mode. When you can see, remove all annotations here. When you can see on the chart what it's doing, and all you have to do is follow along with it. It's just like a surfer jumping on a wave, okay? If the wave is going up, if the wave is going to push you forward, that's what you want to see. You don't want the opposite, where you're trying, again, standing on the train tracks, saying you have to go up. You're going to get ran over. Man, this is a very, very good example. And over this time period, doesn't matter what fundamentals did. Not at all. Because only price pays. So let's do this. Let's rank this video here. Okay, I'm conflicted because up until the last couple minutes of the video, he was getting an 8 from me. I was actually very impressed that he was talking about risk. He was talking about the fact that people absolutely have forgotten how to keep risk as top of mind. In fact, let's look at this. I know that this is going to work great. Give me a second here. Let's look at the market cycle investing thing right here. And let's go back to this. There's Paul Tudor Jones. That is that. These two are the same. This is exactly perfect. Look at that. And it's not this one stock. That's how the market operates. Okay. I cannot believe I found a perfect analogy for these two, a perfect representation. This is what happens over and over and over in the market. Your job is to recognize it. Your job is to see when it's going up and get on board and to get off. And it's not scary. It's not scary if you let the market tell you which direction you're going. Sometimes you might lose a couple bucks, and that's okay. But other times, you're going to make dozens of bucks to make up for the one loss like that. So here's what I'm going to do. I'm going to be generous, and I am going to give him that 8 with a cutoff before he starts saying that you have to have fundamentals, because you don't. You don't at all. Only price pays, right? Now, of course, I want to hear what you would think in the chat. So please let me know how you would have ranked this video. And also tell me what you're trading as well. And be sure to come back tomorrow. We'll help you save time, make money, and start winning with less risk together as a team. YouTube is going to pop up a couple recommended videos. I recommend you watch one of them. Have a fantastic day, and we'll talk soon.